Okay, so let's start today by looking at the minutes from our last meeting. Does anyone have any questions or concerns or changes for our minutes? Has everyone had a chance to review the minutes?
Yeah, I have no changes, but just a couple follow-up items that we can address after.
Okay.
I'd make a motion to approve the minutes.
Okay, we have a motion to approve the minutes from August 12th. Do we have a second? Do we have a second?
I'll second that.
Okay, we have a motion and a second to approve the minutes. All those in favor say aye.
Aye.
Aye. Motion will pass 5-0. Okay. So let's turn the time over to Soltis and to give us a review of what's going on currently.
Okay.
Could I just follow up on a couple items from the minutes?
Oh, sorry about that. Yes, of course.
Okay, the other items I wanted to follow up, in the minutes it talks about adding those who attended the NAGDA conference and the conference of Jim to the fiduciary role. My question is whether that's happened.
That's a good question.
Do we know?
It doesn't, we just need whatever you've got from that conference to send to us. If you have the agenda or any content or your registration, anything like, any documentation that kind of supports that you were there.
I think Mark was gonna follow up on those. At least that's what the minutes show, but I don't know if that's happened.
So Mark, if you want to, I mean, it doesn't have to be formal, just whatever you've got, like the agenda and attendee list, those type of things would be great, and then we'll add them to the vault under your fiduciary training file.
And then the other question I had was, in the minutes, that there's a reference to the discussion which we had regarding auto enrollment, and I think there was gonna be some follow-up with Prudential with regard to whether the commissioners would be receptive to auto enrollment and contribution accelerator. And, I'm just trying to follow, see if that discussion occurred and what the result was.
Yes, it did occur, and the answer was no.
Okay? I just wanna make sure that's in the minutes.
No, good, that's good. That's
Was it-
excellent question.
Just to clarify, no on both auto enroll and auto.
That's correct. We're gonna hold off on those
Okay.
for this year.
Hi, Tyler. Hey, this is Kelly. Would you be able to speak up a little bit? We can't hear the Soltis team.
Sorry, I'll speak into the mic a little better. Is that better, Kelly?
That's much better. Thank you.
Okay, any other questions about the minutes or anything else before we turn the time over to Soltis? Okay. Tyler.
Okay, thank you. We'll jump into just the agenda in terms of the things that we want to cover today. So item number 1 was just done, and we've got a couple of additional action items from there that we'll follow up on today. One of those was to take some time with the committee and us to work with Prudential and help kind of bring some benchmarking around your plans and how you stack up against other government entities and plans and what they're doing when you come to the Social Security shortfall, et cetera. So Prudential's been great. They've got a great tool to help us in looking at that. We'll go through that. That's what this report is that we'll take you through and show you some really good, I think, industry as well as government sector benchmarking data. And then we'll take just a minute on business calendar to kind of look at the things that we've been working on and a report for most of 2019. Obviously, we're not all the way through yet, but close. And we can just touch briefly on the fiduciary training. I know a couple of you are there in attendance, so we won't plan to take a lot of time there. And then, of course, we'll go into the investment review. We're grateful to have Bill Wallace, who's our Chief Investment Officer. He'll also provide an economic update, just a market outlook and kind of how we're looking at things and how we're positioning portfolios, and then, of course, report on the investment menu. And then we'll turn the time over to Kelly and her team on the Prudential side in terms of their plan report, looking at plan and metrics and some of those items. And then we can finish with having Tucker take some time on the education efforts and the on-site visits and things that have been done for 2019 and as we look into 2020. And then the last two items have to do with the benchmarking and the plan document, how the plan document's written, and we'll kind of finish there. So is there anything that's not on the agenda that the committee would like to make sure we discuss or add?
I don't think so. I think that's good.
Okay. If we go on the business calendar, go down to page 7. As a quick reminder, all of the items on the left, so starting on the left, these are all the different areas from a fiduciary standpoint in which Soltis is engaged in working, and so there's a few highlights on there. One is this time of year, and I know that you guys are not an ERISA-governed plan, but I know that you operate in much of the same way that you are. So this time of year, notices that go out to participants. You guys aren't required to send those, but I believe that you do. But that's always an important element at this time of year. The fiduciary training that I just mentioned, we held last week, and we appreciate that multiple of your members were there to attend. We had, just for the rest of the committee, we had the portfolio manager with one of our largest holdings that was there to report that's been a manager that's on watch, and we'll talk about those today. And then we also had the head of cybersecurity for Charles Schwab that was out to kind of talk about cybersecurity and the things, best practices that committees should be looking at and doing in terms of making sure that their providers are, keeping their employees' data safe and accounted for. And then, of course, we'll take time today on the third quarter investment review. So all of the reports that we'll go through today are as of 9/30 numbers. And then on the right there, we'll talk about this, but one of the things that we look at is we look at the average excess return of the investments in your plan. We expect them to be outperforming their peer group and benchmark. Right now, as of 9/30, average excess return for your managers is about 0.88%. That's net of fees. And then percent of the time that they're beating their benchmark is about 82. And we'll dive into those reports. And then the last thing I'll just mention here that's over there in the results and performance is the collectives that we've discussed and put in place. Those are in place and in the plan and running, and we appreciate Prudential's help in getting those there. And of course, those came with a pretty significant cost reduction to your participants in utilizing those collectives. So those are kind of the fourth quarter items. In our first quarter meeting with you, we've got kind of a draft of 2020 and the things that we'll be looking at, and we'll plan to go through that at that point as well. Fiduciary training I just touched on. What I'll mention there is two things. We'll have we don't have the dates finalized for 2020, but we're close. The first fiduciary training that we'll hold, that was just like the last one we held last week, will be right the last week of January, the first week of February. So it'll be right in that time frame, and we'll communicate to you as soon as we have those nailed down. And then our annual conference that we hold that you're all invited to, right now we're looking at the first or second week of April. So we're just trying to finalize spring breaks and some of those things that come with that. But those are the 2 weeks that we're looking at right now in terms of dates. And we'll again make sure that we get those to you as soon as we can. The training that has been provided will be updated into your vault. So for 2019, your vault will include all 3 trainings that we held this year. Any questions on either of those items?
I had a couple questions, just follow up from your conference. One was whether our investment policy statement meets all of your recommended requirements.
It does?
I was assuming it did, but I wanted confirmation.
Yep. So we went through with you guys and adopted the formal adoption of that investment policy statement, and that's what we're operating under. The investment policy statement adopted by the plans is beginning on page 97. So if you want to go through that or whatnot, but that's in there.
And then on the cybersecurity, are you familiar with what cybersecurity protections that Prudential has in place?
Yeah.
Do you have any concerns or
Yeah.
questions on that?
So one of the items that we looked at when we went through the RFP process at your providers, cybersecurity was one of the sections that we vetted with every single provider. And so there's standards that we look for to make sure that they're in place and meeting. We look at what's called their SOC 90 report, which helps you gauge the type of things that they have in place, and it's essentially like a certificate of the precautions that they have in place. So Prudential met those requirements, and yeah, we have confidence that they are operating under those best standards and or best practices, and they're meeting the standards that we can expect from a prudent standpoint in terms of making sure that your employees' data is safe and secure.
Okay, one of the items we've recommended was a two-factor authentication for e-disbursements. Is that in place with our plans?
I'll defer to Kelly on that one. Kelly, did you hear that?
No, I didn't hear anything.
The
I
que-
can't hear anything what the
the-
guys are saying.
The question was that for disbursements in the plan, from a cybersecurity standpoint, is two-factor authentication required for any type of disbursements?
Carol, are we doing multi-authentication for disbursements now? Because we talked about implementing it. Is it on Utah County?
Yes, for any transactions that have financial impacts, such as distributions, we are doing the second authorization for it, authentication.
Great. Another recommendation was that all data be encrypted at all stages, including in transit and at rest. I assume that Prudential is doing that, but I wanted to confirm that.
You'll have to put that in writing for us, Dave, so we can have our IT department answer. But my guess would be yes. Any of the cybersecurity things, you know, we're trying to be a leader in that, and we certainly don't want to get into any kind of issues with financial breaches or anything. So that sounds like something that if you could put it in an email, I can send it off to our privacy area to get it confirmed.
Okay, I can do that. Just for your information, the other areas that were addressed were, let's see, advanced intrusion monitoring and prevention, dark
Yeah,
web,
we have that.
dark web monitoring.
Yep. Do you want me? So we have all of that. Do you want to put it on next quarter's agenda, and I can do I've got an actual like 3-4 page I can add to the book and talk to it.
Sure, I think that would be great. The other item would
Okay.
be network security and penetration testing.
Oh yeah, absolutely. Yep. All of those are
Yeah.
core things that we do on a daily basis, except the one that you had just mentioned. But I would venture to guess we do that as well. But yes, all of those, and I will put it on if Tyler puts it on the agenda, I will bring those pages and we'll go over how we handle that.
Great. And then the final question on that security was whether Prudential has a 100% make whole the employee policy with regard to fraud.
Oh yes, we do.
Yep.
And
That's all
does that include if it's caused or comes through a third party, such as LastPass?
That one I don't know. Again, that would be a good question to put in whether it comes through.
The
a third
answer in the
party.
RFP was no.
Yeah.
So
So could you just add those then in your report for next quarter? That would be great.
Yeah, if you could, Dave, just send me an email with the specific questions. I've got the pre-approved brochures and presentation that I can add, but a couple of those questions might be outside the scope of that. Like the first question and the last question you asked me.
I will do that. And
Yeah, because I just want to make sure I get it right.
I ask the questions not because I don't think you're doing all of that. I assume you are, but we just want to clarify and confirm that.
Sure.
And make sure
Yep,
we have it on
We're getting a lot
record.
of surveys and vendor requests for this type of information right now.
Great. Thanks, Kelly.
Yep. Just so you know, though, this just happened to me with another client today. If any of these questions, some of the surveys and the questions we're getting on our cybersecurity gets into places where we actually ask that you sign a non-disclosure agreement for us to start talking about them in a more detailed manner. If any of those questions arise and we need a non-disclosure agreement, I can send that over to Ralph and copy you, Dave.
Okay. Those are the only follow-up questions
Okay.
I had with regard to that.
So maybe a couple additional comments. So the SOC 90 report that we request and look at from our standpoint, a lot of what you're asking there, Dave, is SOC 90 is like a certificate of, hey, is your company doing these things to meet that high bar? And so if that SOC 90 certificate is available, it covers a lot of those. I think it's still a really good idea to take the time and go through in our next meeting and have Prudential kind of outline that for you. The last thing that I'll say is Soltis, in terms of your employee data, we do everything through Prudential. So we're using our access to the plan with your employees is everything that flows through that. So, and we do that for two reasons. One is that helps protect so that your employees' data isn't accessible through our system, which we work diligently to protect. And each of our machines, all the employees at Soltis, when we have machines, they're all encrypted. That's one of the things that we do. But I just want to clarify that there's not employee data or Utah County data that's housed on any of Soltis's servers or websites. We do all that through Prudential's access.
Or laptops, I guess.
Yep. Okay. Any other questions regarding that? Dave knows because he was there. Anytime you have a cybersecurity training, it's one of those that you're glad you heard it, and then you're also kind of glad sometimes you wish you didn't.
Wish you hadn't heard it.
But I think it's something that's evolving so quickly. The gentleman we had from Schwab, that's their head, he talked about daily, they see different things almost on a daily basis. So and of course we all recognize and we know, you see it plenty in the news, but that's a very important thing. And as you can imagine, from a record keeper standpoint, Prudential among others, the ability to have breaches there can certainly hinder their ability to keep and maintain and win new business. And so I think the record keepers, your question about two-factor authentication, we've pretty much seen all of them move to that type of security. And if they haven't yet, they are on their way.
I'm still not sure how to get on the dark web, even though we talked about it. Was I just not catching it?
You have to be invited.
Yeah, you do.
Yeah, don't do it, because then they start sending you all kinds of crap, and you can never get out of it either.
That's right.
You want me to send you a link, Ralph?
No, it's okay. If the attorney's office has a link, they can keep it. Okay.
Yeah. Okay. Well, let's jump into the investment review, and I'll turn the time over to Bill Wallace. And as I mentioned, he'll take some time on an economic update. And I think, part of today and having Bill here is just to give you an idea of what we're looking at. As you guys know, we constantly are watching the markets, as you can probably guess, and looking at different elements in the market and trying to have a good idea of what we think, what risks and what opportunities might be out there. And then we look to position portfolios on our clients' behalf according to some of those things that we recognize. So we'll have them take some time there, as well as follow up. There's 3 managers that are currently on watch status. So there's only 3 out of all of your managers, but we'll take some time and report on them as well.
Thank you, Tyler. If you go to page 15 in your packet, we'll start there. And under the market commentary, equity markets are doing well this year. The U.S. markets are pretty much leading out with returns in the double-digit levels. International markets are also providing, in terms of equity markets, are providing strong returns. The bond market, with interest rates going down as much as they have this year, we've actually seen strong returns in the bond market as well. A couple of things that I thought might be interesting. Two graphs on the right-hand side of page 15 are kind of interesting. You are hearing more about negative rates. That's a phenomenon that's happened outside the U.S. This chart here just shows you, on a global basis, the amounts that are in negative rate territory. So you have in excess of 20%, looks like maybe up to the area of 30% that are, below 0% in rate. And then on out. So rates are very low. This negative interest rate phenomenon is really something new, something that we believe needs to be changed, that it doesn't make sense. We think that with a new central bank leader in Europe that we may start to see a little bit more of what we would call sound policy, where they start moving rates back up to more normal levels. The other chart there that I think is really interesting for perspective is this goes back to the early 90s and just shows you what's happened in the U.S. equity markets during that time period. Obviously, in the 90s, we had a great decade there, up about 100% plus. Then you had the tech bubble crash, which was down about 49, and then another 100% period of returns with then the great recession, where markets went down about 57%. But then we've been on this really phenomenal track here in the last decade or so, up about 340%, with a couple of fairly significant drawdowns, but nothing quite like the big drawdowns we had in the early 2000s and in 2008. Just to remind, I guess, that if you stay the course, you're going to earn money in the stock market, but you do have a volatile ride sometimes. If you go to the next page, page 16, maybe just a synopsis of a few things. We think that the economy actually, even though the economy is in its longest expansion ever, we think that the economy can continue to grow here in the U.S. Some of the reasons for that is job growth continues to be good throughout the country. Unemployment is low, but we get job creation month after month, which is a real positive. It's making the consumer really willing and able to spend and help keep the economy moving forward. Interest rates are low. The latest moves from the Federal Reserve has been to lower interest rates, as you probably know, which was a fairly significant and abrupt turn from a raising rate campaign. They've lowered rates 3 times this year, a quarter point each time. We think that those rate decreases are on hold now. We would be surprised to see the Federal Reserve do any more of that. We actually were in the camp that said they didn't really need to lower rates, but nonetheless they did. We think the odds of a recession in the next 12 months are low. One of the reasons, if you look at page 17, the leading economic indicators report we've put in here, you'll see on the upside the positive green indicators, and then the down. We continue to get positive results from the leading economic indicators, and essentially what this comes from. The Conference Board is a think tank, kind of unbiased group. They're essentially saying that leading economic indicators are indicating continued growth, but modest growth, not robust, but just decent growth. We're talking about GDP growth of about 2 to 2.5% this year. That's kind of what I have to say on the economic side. I would be happy to stop there and see if there's any questions from the committee before we take a deeper dive into the investments.
Just a quick question with regard to presidential election. Any indication or feeling as to which way the market will go depending on which party wins?
It's interesting. That's a good question. We're actually just starting to study that, and we'll probably have a better answer to that. But in general, the markets can tend to do well under either administration. Interestingly enough, sometimes the markets do the best when you have divided government. Then it makes it just harder to make changes. If you have a whole, a Democratic or a Republican, if they control the House and the Senate and the executive branch, more can be done, and that can be either positive or negative. I think it's kind of too early to tell. The markets could be more volatile in 2020 as you get the uncertainties of what's going to happen. But at this stage, the market seems to not be really cluing into the election yet, because the markets have been very favorable and volatility's been fairly low, and so I don't think that, I've actually been thinking about that, the election doesn't seem to really be on the radar screen of the markets quite yet. Other questions?
If I can maybe add a comment, maybe when you think of the markets, one of the things we look at is what markets don't like is surprises or uncertainty, and so things that they're not expecting will tend to create pretty high volatility. I'd maybe say a couple of things. I think one is we look at the market, and we know obviously every day on the news you hear the impeachment trial and that. I think it's safe to say the markets haven't priced in an impeachment scenario, whether that happens. So if that were to happen, I think that would probably be something that could surprise the market, and you could see some volatility there. The second part of that would probably, that's driving that a little bit would be, you know, a significant change in tax policy. So, I mean, it doesn't really matter, I guess it does matter which side of the aisle you're on. There's some that would argue, but I mean, if you look at the tax cuts that were put in, they had a boost in the economic and earnings and things like that. I mean, there's really hard to refute that. Whether those get rolled back or that gets changed dramatically is something again. And you've seen some of the big players in the market kind of begin to make statements publicly about how detrimental that could be to not just to the economy, but to, you know, workers and everything like that. So I think those are two things that we're watching very closely, and I would say those are two things that the market hasn't really priced in or is expecting, and so, you know, those are events that could potentially drive some market volatility if we were to see something happen there.
One other thing maybe that we'd mention that we think has been a really good thing that came out of this current administration was the decrease in regulations, making for a more business-friendly environment. We think that's probably even more than the tax cuts. That's probably why we've had the growth we've seen and a lot of positive outcomes. So that would be probably an area to watch with you know, whatever the next administration is, you know, will you continue with kind of the more positive regulatory environment, or could you get back to more of an environment where they want to increase regulations and make doing business more difficult? If you turn to page 21, I thought it might be worthwhile to just dwell a little bit on the plan values. You'll notice here that from a year ago, the plan was at about $108 million. It's had fairly substantial growth with at $141 million, and that's obviously a function of market returns and also new investments. I thought it would be interesting, though, if you look on the far right, you can see the percentages of where plan participants' money is. One notable thing, there is nearly 33 million, or 23% of the plan is in the cash category, which is probably an education opportunity. We really want to see plan participants be, you know, involved in the bond and equity markets, because that's where you'll get more growth and more return. And then as you just kind of scroll down through, you can see the different amounts. One thing I would note is it appears that plan participants tend to be more comfortable with actively managed funds as opposed to the passive. So as an example, if you look under the mid-cap section, the Fidelity Mid-Cap Index has just 0.29 of 1% allocated there, where an actively managed fund in the mid-cap space has 5.3%. So it'll be interesting to see, again, in the small-cap space, 0.37%. We're big believers in having passive as well as active options for your plan participants. But again, I think it's interesting to note where some of the percentages are. But nonetheless, great growth. The weighted expense ratio you see there at the bottom is 0.54%, which is pretty attractive level, especially when you have that much money being invested in your active managers, because the active managers are going to have higher underlying management fees than a passive investment index.
Bill, it looks like the cash and equivalent increased quite a bit in that period of time. Went up by 10 million. Do you think part of that is retirees putting the money back into cash, or what's going on there?
That could be. I mean, we don't really know for sure. I guess one thing, the dollar amount is substantial. I would note that the percentage amounts is not as dramatic. You go from essentially 21% to 23%. But nonetheless, yeah, we're not sure how that's happening in Tyler. I don't know. Is there a way to try to study that to see why that's happening, or?
Can look who's making one thing I would say is we, you know, in this industry, when you have a market that runs and does pretty well, I would say in the last year, we have a fair amount of clients that are kind of going, hey, it's been pretty good for a few years now. When's it gonna tank? And if so, I don't wanna be in it. So we've had actually quite a few conversations with clients in the last year about, it's really tough to time the market. We don't advise you try and do it in terms of, hey, I'm gonna go to cash now because I think the market's going down. But
Yeah, 'cause those
I
other
would have a
areas-
feeling that's coming into play.
Those other areas, percent-wise, they went down even though the market was bringing a lot more money in.
Yeah.
It seems like
Yeah.
all of a sudden we got
One
rushed
thing that
to
occurred
cash.
occurred to me too is we had, and maybe it's easy to forget when the market turns around, but we had a really big drawdown in the fourth quarter of last year.
Last
It was
year.
down about, 15%. Actually, it was down 19% in one quarter. That's a big move pretty fast. That may have kind of
Yeah.
scared some participants. And then Tyler's idea that maybe people are saying, I'm taking advantage of this run up and I'm gonna scale back, that could be one as well.
And we've talked about it with the committee a little bit, but I think as we look into 2020 in terms of education, this is an area of your plan that we would be eager to try and help in identifying. We can certainly work with Prudential, identify who's in that. And what I would say is we're not trying to tell people they shouldn't be in cash, but I think part of that is, are they in cash intentionally? And if so, what concerns do they have? And if that's really the appropriate place for them to be, then they should be there. But if it's a unintentional position, which I'm guessing you have a fair amount, that just went in there initially and they've never changed over the years, that's a discussion where we can certainly help them. And it's a little bit too bad in that as you look at 08 to now and you think of 300%, certainly cash has been a pretty tough place to be in terms of trying to keep up and growing your money for retirement. So
Cash was the best asset class in
true.
2018 though,
Yeah.
which doesn't happen very often, but it was. Maybe that's another reason.
so
If you go to the next page, the 457 plan, the percentages are kind of interestingly fairly similar. There's that 32% in cash equivalents and on down. Obviously, this plan size-wise is not as the same magnitude as the other plan, but let's go in, if you go to page 24, this is our summary page. Tyler mentioned briefly that we have 2 managers on watch from a quantitative standpoint and 1 manager on qualitative. I would also note the large majority of the managers are getting green check marks for both quantitative and qualitative as you look down the middle of the chart there. So the plan, I think, is in good shape. It's not unusual for a manager to go on watch, and our philosophy is we don't automatically, say, let's get out of this manager when they go on watch, because oftentimes all managers, active managers, will have periods of time where their style's out of favor, and typically that's a good time to be putting money with them because they're probably owning stocks, for example, that aren't doing as well, and so it's kind of a way of buying low. So we try to be patient when a manager goes on watch. We have no recommendations for change. As you can see here, the JP Morgan U.S. Equity Fund is on watch on the 5-year basis. So the quantitative watch is all about performance, whether it's versus the benchmark or versus their peer group. And they actually are doing okay in the peer group, but on the 5-year basis, they are underperforming their benchmark by about 75 basis points. So that's really why it's there. On a 3-year basis, it's 5 basis points. So those are numbers that don't alarm us. Thus, no recommendation for change. Under the Invesco growth and income is kind of a similar scenario. The underperformance is not of a level or a time frame that we would be concerned. You know, we'll be patient for a period of time, and it can kind of vary based on what's happening with the manager. But typically, we're gonna give it at least a year, maybe sometimes longer, if it's a strategy and a style that we have strong conviction to. And then lastly, the American Funds Euro-Pacific Growth. This fund is on qualitative watch, and so rather than looking at performance here, we're looking at underlying factors in the fund, like, is the manager tenure long enough? Has there been a change in manager? Are they sticking to their style? Sometimes you get style drift. What kind of risk levels are they taking? So it's again, quantitative versus qualitative. The reason why the American Funds Euro-Pacific Growth is on watch is one of the managers left the fund. And I emphasize managers. One thing about the American Funds platform is they manage funds with teams of managers. Rather, sometimes you'll have a fund where there's a lead manager or a star manager, and if that manager were to leave, it would really raise red flags. But when you have a team approach like the American Funds do, a turnover in manager is something to be aware of, but it's less significant because they're not the lone decision maker on the strategy. So no recommendation for changes there. So Tyler, did you have any other color you would want to give on that?
I would just add on your two managers in the large cap space, the U.S. equity and then your Invesco growth and income. Those are both on the blend and value side of large cap. And that's been a tough environment for active managers in the last year. When you have a market that's up double digits and you kind of have the rising tide lifts all boats effect, those are tougher environments for a value manager to operate in. And so it's not terribly surprising that they're underperforming a little bit based on those numbers. Where those managers tend to do better is when we begin to see some volatility, or you have a market that doesn't just go up 10 to 15% a year. And so, so while we never want to see underperformance, part of us is looking at their style and how they manage money. And there's certainly going to be times when a manager's going to be out of favor, or they're going to have a tougher time performing. And this would be the environment we see in large cap value is more of the environment we would expect them to probably not look great as we do that. But again, watching them closely, these are both Morningstar rated managers as well. And so we don't have worry around their organization or their personnel. Those are still in place. Any questions or comments or concerns? Okay. With that, we won't take the time to go in there, but I do want to just show you real quick on the collectives. If you go to page 39, so as most of you know, we don't need to take a ton of time here. What I wanted to show you on 39 is the collectives that are in place, and as you all know, we made that move to the T. Rowe Price who you're using, and we have the collective that's at a lower expense ratio. Because that is in a different share class and it's in the collective, your participants, when they log in, they're not going to see the ticker from T. Rowe Price, but this is what they should see when they click on that portfolio. Is they'll see this fact sheet, and so it comes up and it shows that, and then of course it talks about what each of these are invested in, and so it should be very clear. We haven't had, we had a few participants on site that we had questions about those changes, and we of course took them through it. But we haven't had any participants that have called or had issues or anything like that. And I think if they've asked questions, it's, hey, you're in the same fund you were in before, you're just paying a lower expense. But I wanted just to kind of bring this to your attention so that you know that as participants, if you're in them or one of the employees are, when they log in and see that, rather than see the T. Rowe Price fact sheet, they pull up this, which basically shows and looks very similar, but it's because it's in a collective, it's a little different.
And is it because the collective's so new? Because I've had some comments that they were concerned about not being able to see a lot of information from the past of the collective. That all they were getting was just what recently has happened.
Yeah, so
Case.
Yep, so one of the challenges when we do that is we create our own share class, and even though this fund has been around for 15 years, these funds have, the SEC, who is our regulatory body, won't allow you to say, they won't allow you to show hypothetical performance on a website basis. And so you're only allowed to show the performance of how long you've had that. So yes, when your participants log in now, if you go to page, for example, 55, this is showing you the 2030, this fact sheet, and you'll see on that fact sheet that we actually are able to list those numbers. And the way that we're able to do that is it's denoted that if you look there, see the year-to-date number, you'll see that there's no asterisk by that one. Or excuse me, the 1 month number, but then as you look past in the 3 month number, that once you get to the 1 year, 3 year, and 5 year, we do provide those numbers. And then of course that's disclosed right below that those are representative of the TRRCX strategy historical performance. So it's kind of a way for us to try and make sure that those participants can get and see the performance. But yeah, that's in terms of the SEC and or FINRA, and FINRA's not a regulatory body for us, but they don't allow you to take performance, and they don't allow you to transport it over to a new product, even though it's the same product, just at a lower expense. They just don't let you do it. So these should be available as your participants are in there. If they see it, they can click on this and bring it up. They should see those numbers. And we update these every quarter, so.
But even these investments seem to be heavily invested in T. Rowe Price, is that correct?
Yes, it's T. Rowe Price's target date series. So all we do in the collective is they create a share class, and we take all the money, we invest it right into that share class. So it's the exact same fund.
So when you're looking at the investment option quantitative scorecard detail on pages, like page 33,
Yep.
other than the target date, the only SIA is under large cap.
Yep.
Is that right?
Yeah, so there's the T. Rowe Price large cap growth, which we also have a collective for that we're using.
So with regard to the collective, it's either the large cap growth 2 or one of the target date funds, right? Otherwise,
Correct.
you're not involved in the
Correct.
collective.
Correct. Okay. Yep. And then what we do is because those don't have the performance that's there, if you look down a page, from a fiduciary standpoint, of course, monitoring and documentation of that, beginning on page 63 is the target date, what's called the target date compass report. And that goes in and does provide, in that report, we're able to go back and say, hey, based on the share classes that we used to have, we can show those reports. So, so in this report, all of those numbers, the 1, 3, 5, 10, since inception, the calendar year returns, those are all here and being documented and tying into the investment policy statement. So it's a little bit of a workaround we have to do in the reporting system, just because of, again, the share class, once it's created, we can't transport old performance over. But in terms of fiduciary and documentation, all of the monitoring is still happening and all of the numbers are being looked at and documented here.
Again, the goal is that this creates a better return for our
Yeah, it's
Employees,
essentially,
right?
yep, it's essentially looking at the ticker symbols that we use that have all the track record. They're basically 0.35% higher on average than the share class that we have. So this performance is roughly it's understated versus what your participants are getting by roughly that amount. It won't be exact because markets move, but. Okay. With that, in terms of the agenda, happy to turn the time over to Kelly and Carol and have them jump into, of course, if there's no other questions on the investment menu or the recommendations to continue to watch these managers that are on, the 3 that are on watch.
No, I think we're good.
Okay.
Yep, thanks.
Kelly, we'll turn it over to you in terms of the prudential report, and which will be
Great,
this
thanks.
copy, and you should each have a copy of that.
Yep. So does everybody have their copy of that? We'll start on page, let's see. Under the first tab, just talking about the combined plans. So the combined plans, as of 9/30 were just under 165 million. And we have 762 active participants with balances in both plans, and this is on page 3. I'm not going to spend a lot of time on the expense account because I know Carol does send this to you prior to the meeting. However, does anyone have any questions on any of the expense account items that she has listed here? And then Carol, do you just want to update the committee on where you're at with the reallocation?
Yes, thank you. So we did receive the approval to reallocate all of the assets that are in both the surviving plans, the 111414 and 415, which is your 457B and your 401K plans, and we're going to leave a total of $200,000 in assets in the management accounts, and the rest of the balances will be reallocated to your participants on a prorated basis. So that should happen within the next several weeks, I would say.
How will that show up to participants? Will they be able to see what they got out of that reallocation?
They'll be able to see it as I believe we received this instruction that it would show up as an employer contribution.
Employer contribution.
Yeah.
So, okay.
So you guys
What-
take credit.
Why would it show up as an
It'll receive
employee
the credit,
contribution?
correct.
So Carol, the question is why would it show up as an employer contribution as opposed to just a general credit?
Well, we have in the past been able to show it as an adjustment or perhaps an earnings, but the choice was made to put it as an employer pre-tax non-elective contribution, which I believe is how it was handled when last time that we did the allocations back in 2015.
Well, this is Dave Shocker. I have a question on that because in my view, it's not an employer contribution. This is a refund of expenses that were withdrawn from the employee's accounts. So it should be just a refund of expenses previously withdrawn or withheld.
So I think that's a really good, question, Dave. And again, the reason why that was made as the choice is that's how we did it last time. That was the way it was, characterized on the statement. I actually don't know what the other options are, and if there is one that's better. And I think we should look at that. We should talk about that. Carol, do you have any thoughts on that?
Yeah, let me find out what the different options are. I know there are several ways that we can have these posted. And so if you had your choice, you'd rather it just show up as sort of an adjustment?
Well, yeah, I'd like it to show up so that it reflects what it is, because these were withheld from employees' accounts, and it should be just shown, in my view, just as a refund of excess expense withholdings.
Yeah, I tend to agree, Mr. Ralph, I tend to agree with Dave. The other thing, if it's put in as an employer contribution, how do you know you really got it? There's nothing, unless you're tracking the employer contributions carefully.
Yeah, I'm pretty
how would
sure
you
we
ever know
can't
you got it?
customize what, I think what Carol's gonna have to do is send you a list of what we can do, because I don't think we can customize it to each, we have certain ones that we can call it a miscellaneous credit, we can call it a, employer contribution, employee contribution. I think there's sometimes when you're doing, like a QNEC or something where we've made an error, there's some for those. But I think what we need to do is have Carol send you what our options are, because I don't think we can just customize one and say it's a refund of employees for expenses. I've never seen that. So Carol, can you check and see what our options are?
Yes, absolutely, I will.
Yeah,
Carol,
but from
feel-
what you've described there, the miscellaneous
Okay.
sounds the most descriptive. At least it wouldn't be misleading as to, because the others would be. in
And
my
we
view.
could send out an email even to participants saying when they see that, that's what it is, so that they know that
Well,
they're
we do have
getting the money back.
a little box on the top, Ralph,
Uh-huh.
that we can put, and I don't know how many characters we get in that, Carol, that we could put what that is.
An
on
explanation of
the-
what it is.
on
That'd
the
be good too.
statement.
Yeah.
We can see, I know that it's not a big box, it's just kind of a box you can put a blurb of something in going on the plan. Maybe you can look into that too, Carol, and see if we can update it in that spot.
Carol,
Yeah,
if you'll
put a
just,
message
if
on
you'll
the
just
board
copy us
recording.
on it as well, just maybe for perspective for the committee. Mostly when we've seen this, it shows up as a rebate or credit, the way that we've seen other providers kind of title it as a revenue credit or revenue rebate.
Yeah, anything along those lines I think would be fine,
Yeah.
but I think it needs at least not be misleading.
Yeah, I think that's a good point.
And some employees are aware of it and they're expecting to see it, and you know, like I say, in employer contribution, I don't know that they'd see it, so.
Okay, we'll work on a little statement that we can put on, a message on the statement, fourth quarter statement, just saying what, directing them to the miscellaneous credit, or whatever we decide to have it called. And then Ralph, we can get those to you so we can talk about it in the next biweekly. We'll disseminate it to the committee and to Soltis, and then you can tell us in our next biweekly call how you want us to handle that.
All right, sounds good.
Okay. Okay, so let's see. I'm just doing a time check here, about an hour in. So if you want to turn to page 17, we can go over the quarterly statistics. Total participants in the plan have increased by just a little bit, from 1326 to 1339. We have as well just 10 more terminated participants. If you go down to about the middle of the page, we have more than half, I'd say more than half the plan, or just about less than half the plan, excuse me, of participants 50 and over, which hold 2/3 of the assets, which is $91.2 million. One thing that we'll talk about in conjunction with, and I see Soltis has it on the agenda, is communications and education, and we talked about this Friday. Just so you know, the Prudential Pathways people that we had in there, I had a call with them earlier today, and we can set up some 1-hour webinars, Ralph, that would talk about pre-retirement planning, and they have about 7 or 8 different, where it really narrows down to different types of things you need to think about when you're getting ready to retire: health insurance and Medicare and Social Security and a lot of different things. And what we could do is in conjunction with Soltis, is run those webinars for those people in this age group, and then they can either do the webinar and or a 1-hour on-site, and then knowing that we have this, then when Tucker comes monthly, he'll have a list of who went to these in these webinars and or hourly seminars, depending on we're doing it as webinar or if we're doing it on-site. But I kind of thought we could talk about that, to start out to 2020. So I'll be getting more information on that further. If you keep going down, you've got contributions that have gone down just a little over $2 million. And then we did have distributions go up just a little bit, just 0.1%. And then just so you know, the total participant balance is $141,484,000. I did check the balance as of last night, and it is up about $3 million to $144,655,000. So, but I did peek at the market today too, and the market's been doing pretty darn good these last couple of days. So that's where we're showing that growth at as well.
So Kelly, a
any
couple
questions
questions there.
Yes.
First, do we have any missing participants that a number for those, or do we know where everyone is and we are communicating with them? Do you know?
Yeah, we're going to know where all the participants are from the information we have. If we have lost participants, those statements, and Carol, keep me honest here, I believe those go back to the plant or to you guys, and you either look for them or you put them somewhere, if you have any lost participants. But there would be accounted for in here as terminated participants.
Yeah, and I'm not talking about terminated, I'm just missing participants where we have funds, but we can't locate the individuals.
They would still be considered terminated participants
Oh, okay.
because we would have at one time had information on them.
So
Kel-
there's a
We don't have
report.
Go ahead.
I'm sorry. So there's a report on the website that shows participants that have what we call invalid addresses, and so we do ask that Utah County kind of looks that over and lets us know if they have a more recent address that we can update to send to them. Otherwise, the statements no longer get mailed. Of course, they're available on the website, but we no longer do any mailing until we have a valid
Right.
address to use.
So Ralph, do we know how many, do we have very many of those, or do we know how many we have?
No, but I can find out.
I think that would be good to know. And then the follow-up question on the distributions, the total distributions of $2.2 million. Are you aware of anything that we could do to try to reduce those distributions by way of communication or information, or I think it's to everyone's advantage to keep those funds in our plans. So my question is kind of a general one as to whether you think there's anything that could be done to keep those distributions in the funds.
So if you want to turn to page 21, we have an asset allocation activity report by age, and it will show you what types of distributions have come in and come out. And the rollovers out, it does look like the majority of, more than half of, or about half of the assets in those distributions were in the age group of 55 to 64. So whether they're taking it out to retire, it doesn't look like under the age 55, it's not a significant amount. I guess it's, 45 to 54 is pretty high, and then 35 to 44. Is that the ages that you sometimes see your firefighters and your police people retire? Don't
Right.
they have like a 20-year in?
And I understand that. So my question is there any way, or do we see anything that we could do to, by way of education or plan amendments that would make it more enticing for them not to roll out when they retire?
So,
There's really nothing we can do from a standpoint of the plan level. It's probably something that Tucker and his group, when they talk to people on a one-on-one, or if they call into the call center, that is something that we always talk to them about, is how the fees inside of the plan are significantly less than if they go outside the plan. And I'm just wondering if we have any stats on that.
Kelly, do the distributions out include loans and hardship withdrawals? Do we allow
No.
hardship withdrawals?
Distributions might, but for hardship, but not loans. Loans are
loans,
held
okay.
differently.
Hardship maybe, but not loans, okay.
And we don't have
So-
that many.
Carol, would you know is
hardship
hardship's considered? It would be, because
think
they're not
hardship
expected
is.
to pay it back.
Usually it is. It's
It is,
included in
but-
distributions.
Yeah.
Correct,
don't
yeah. The
see a lot of
distributions
that.
would include the hardship withdrawals, but not the loans.
So maybe a thought here, and we talked about this a little bit earlier with, this isn't uncommon in terms of looking at your population. And I think there's two things I'd probably say. One is there's a fair amount of our industry that recognizes people when they're 5 to 10 years away from retirement, they've built up a pretty good nest egg in their 401k. And so they'll target those people and say, hey, let's roll it out of the plan and we can help you, do some things. And sometimes that may be beneficial if there's planning and some other things are happening. But it usually does come with a higher fee. So it's not real uncommon. I think what the other part is when people get to that age, they're not quite sure what their options are. And so as Kelly mentioned, and you guys have seen, we've done a couple, we do 2 of them a year called these retirement readiness sessions. And those are really to help people that are 50 and older to kind of say, look, as you get ready to retire in the next 5 or 10 years, here's the options you have, and here's the different things that for you to be considering, whether it's Social Security, estate planning, what do you do with your investments? And so I think one is, I would just say, helping people be better educated about what their options are would help. And so while we do that session and we do it jointly with any of our clients can come, if there's a need or a demand to where to do it specific for the county, we pick a day and we do it here just for those employees, we'd be more than happy to do that. Because I think a big part of this is just educating them. A lot of them don't know, hey, when I retire, I can stay in the plan. I still have all the access. I still have access to Soltis and all those type of things. They're just not really aware of what their options are and what to do. And so, a lot of times they get approached with, hey, let's roll it out. Let's get it to this or that or an annuity that's how you got to start generating income. And they're, for lack of a better term, they're not really aware of what all their options really are.
Right, and we did in all the meetings that we did in June when I was there, with all the plan changes. We spent quite a bit of time talking about the pricing on the plan because of going to the zero revenue share and what talking about the target date funds and how that pricing is an institutional really good pricing. So we do talk to them about it, that it is less expensive if they keep the money in the plan, but it's probably something we have to continue to talk about. And then the other thing as well is if they are looking at rolling into an income stream annuity, we do have that in-plan option as well that is in the plan.
Yep.
So that also, I'll make a note of that, and that's something that we can make sure that we're aware of as we plan for 2020 communications and education.
Yeah, that's a great example because the flex income option in the plan has significantly more flexibility and significantly lower fees than an annuity option.
Oh, yeah,
Annuity
for sure.
options
Yeah,
outside of the plan. So if that's something that
Probably
somebody's
a 1.5
wanting,
to 2% cheaper
plan
than
offers
anything
an
you can
option
get in
already.
retail. Yeah.
And I did want to point out that on page 32, further into the booklet, it seems like the termination distribution amount actually has gone down for terminated employees, whereas the in-service withdrawal has gone up. So perhaps there's other things at hand. The Quadro was processed, things like that in the last quarter.
Thanks.
Yep. The next pages that I wanted to look at, we're going to skip over the benchmarking. I do put these pages in here on page 19 and 20 every quarter, but I'm not going to spend any time on them because I know that we had sent Tyler the more inclusive and more detailed report that we're going to be going over in a minute. So we'll go ahead and just go ahead past those. If you want to turn to page 23, we'll talk a little bit about your participation rate is still floating right around between 76 and 78%. If you look on the next page on 24, we've got about 14% of your population not contributing to the match. I know that that's been something we had talked about. How do we get those people to understand that they should be at the match? So that is something that we can work on as well to maybe build an email campaign to everybody to just remind them in that targeted demographic that they are not receiving their full match. I know that probably came up in the benefits fair that was held last month, but again, it's a good reminder to make sure that people are at least the match, which we have almost 60% of the population. And then we do have almost 13% of your population at more than 10% too, which is great to see. If you turn the page to page 25, the retirement income calculator always has some pretty good stats. So you had 60 unique completions with about 12 people going back in to update their information, and out of those 60 people, 23 people increased their contribution. So again, the right behaviors that we like to see. And then I won't spend a lot of time on it, but the grid below it just talks about how people that take more time and pay attention to their finances generally have higher account balances, that sort of thing, and that it does look like that's the case, where you've got people that haven't gone through the RIC are at 6.59, but those who have gone through it are almost at 8%. So it does show you that those people tend to be, savers, the ones that are taking the time to look at their financial wellness. Just to kind of briefly talk about Income Flex, page 26, participants that are rolling at Income Flex, we have 23, and we have about $75,000 is the average balance that's in there. Again, that's something we can incorporate with making sure that Soltis has all the information they need for Income Flex. And we can also do some education around Income Flex, again, in that pre-retirement, because what they can do then is everybody has a pension, but they can take this and they don't have to put all of their money into Income Flex. They could have, say that their pension is creating, I'm throwing a number out, $1,500 a month in income, and they need another $400. They can take half of their 401k plan and just use that much in Income Flex to help create an income and leave the rest in the market to do what it needs to do. So there's lots of things that you can do with Income Flex that we can talk about. Is there any questions there before I keep going?
Just one real quick, Kelly, this is Ralph. Have we ever surveyed the employees who are not participating in the match at all to see what their reason is? Is it always economic? Do we know if some
I don't think we've surveyed them,
don't
no.
understand it? Or?
So we haven't done an actual survey since I've been here, but anecdotally, I can tell you that employees, especially the younger, newer employees, feel like they cannot afford it, even though we tell them that they cannot afford not to do it, but they still feel like things are so tight that they can't afford that 6%, which is unfortunate.
What would they do if you're still on Social Security? I mean, it'd be more than 6%,
Right.
6.2%.
It wouldn't be optional though.
And that's not optional.
So it is a little bit of a quandary there to.
I don't think employees are coming here because we're not on Social Security.
Yeah, something I've thought about doing, and maybe Kelly or Tyler can help with this, is having because of course they get inundated when we do the orientation, and I've thought about setting up a reorientation about 6 months in for the new hires to make sure they fully understand the implications, because at that point in time is when they really can start investing, and I think they've already forgotten what it is that we offer as far as retirement. So I'm trying to set something up that's a regular. Something that's almost mandatory for new hires. They have to come in and be reoriented to their retirement plan.
Probably a good idea.
So whatever you can help with.
Yeah, I'd say we're happy to do those. I think even the more specific and targeted we can be. So if it's, hey, you've been here 6 months and you're not there, so what I'm kind of getting at is the more we can target groups that have the same issue.
Mm-hmm.
So maybe one group, it's, hey, you've been here 6 months and you're not in here yet. Let's meet with you. Come and do a meeting specifically with them. Maybe the next meeting might be, hey, you've been here a year, you're in here and you're contributing 2%, but why aren't you doing more? We can have that discussion. Much more effective in terms of getting the people in the room that have the same type of challenge and helping educate them, and then giving them a way before they leave that room to say, you know what, I should do this. Just, I'll sign this paper and off I'm going.
Okay.
And I think we can certainly help in doing that. That's part of the targeted stuff from 2020 we want to look at.
Good. Yeah, that is one of the goals for for my department for 2020 is to start doing that some sort of reorientation with our new hires.
Well, and if they're a new hire who hasn't worked anywhere before and this is their first time working, maybe it would be good to do it after they filed taxes for the first time, so you can show them how much money they would save if they did something like this.
I think
in addition to what they can get back if they do leave.
Yeah, I think more information is better. And again, I just don't think they get it in that first orientation. It's just way too much information.
Oh, one thought I had is with regard to our health insurance, you have to have a health evaluation. Everyone has to come in to do that.
Right.
And I'm wondering if you couldn't maybe have a financial evaluation, just a station when they do the health evaluation, just to drop by, quick review of where they're at, and then
It's part of the wellness program.
Yeah,
That's not a bad idea, Dave. I really like that actually,
Health and
because
wealth is,
you could, capture a lot of people there,
Turn
because
your
it
ear
is.
off.
it
Well,
is
if they
part
come
of
through there, it wouldn't, I mean, it can be done quickly, just,
Yeah.
especially with some of these that aren't even at the match.
We usually do our wellness early in the year.
January,
January, yeah.
I think they already have, well, I don't know if they have dates yet, but typically in January.
It might not be something everybody needs, but we could probably identify those who could use it.
I like it.
Yeah, so if you look on page 28, kind of in line with what you're talking about, Ralph, is the people that need to be reoriented. You can see that we had the number of participants who stopped participating during the reporting period was 4 people, and we auto-enrolled 112. So as 4 doesn't seem like a lot, that's just in the quarter. You had 4 people get auto-enrolled and or decide they couldn't afford it for whatever circumstances might be, and went to 0. So, that is something that, that's happening in your plan, because the next number talks about how many declined it in the auto-enrollment period, and nobody did. So usually what happens is nobody remembers to go out and say, no, I don't want to be in it. But then when it starts coming out of their paycheck, they're like, oh, where is this going? And then they go out and they decline, and they change the rate to 0. So that might really help in a enrollment type situation to know who those people are that did that.
Yeah, and I think it adds up over time. Obviously, the numbers of folks who are doing 0, I think, is just increasing.
And there's always the option too, which I do have some plans have done this in the past, where they just decide to do a one-time re-enrollment, where they just pull everybody back. They communicate it out, and they say, unless you go out and you decline on this date, we're going to bring everybody up to 6.2. Generally, we do that when we start auto-enrollment, but I've had 2 other plans say, no, we've had too much disenrollment, and they go and they pull them back up and make them opt out again. So just putting it out there as an option. It doesn't have to be something you do, but just be aware it's available.
Okay, all right, thank you.
Yep. And then let's move on to page 33. We'll just quickly talk about the loans. Your average loan balance is about $10,000. That's pretty average. It's just a little bit above where our Prudential book of business is. Your participants that have outstanding loans is a little bit higher. It's at almost 20%. That's a pretty high rate, especially for a county government that you don't generally see quite that high of loan usage in some of the other government plans. And then 16% have multiple loans, which is lower than our Prudential book of business. However, sometimes that can be concerning as well, because they're using it for like an ATM machine, that sort of thing. So as we talk about after-tax dollars and things like that, I want you to be aware that we have a new ability to be able to save after-tax. We call it the emergency savings ability account. It can be a sidecar savings. You've probably heard about it, Tyler. But that is something that we would be able to put on along with the after-tax savings as just a way for them not to go in and spend down their loan dollars that's supposed to be for retirement. You can set it up so that they can save it in after-tax and then have it payroll deducted. I like to call it remember the old Christmas Club accounts where you'd save $1,500 for Christmas, and then in October they'd send you a check?
And hardship withdrawals, an average,
Well, you're a non-ERISA plan, so you don't, you could set up your withdrawals and distributions really any way you want to. Not necessarily. Most of my plans offer 2 loans. I have seen a couple of plans move to just 1 loan, and then they have brought up what the minimum amount is from like 50 to 100. They bring it up to like 500 or 1,000 to stop those people that just use it as kind of like a little ATM. But I wouldn't say that your loans are necessarily bad. 20% is a lot of people having loans out. you know, it's just things that we can work on. Again, Tyler and his group can work on it. It's things that we can do, send out targeted emails to people who have loans, remind them why it's, you know, it might be better to use a different source of money, that sort of thing that we can do as we build a 2020 communications budget or education calendar. And we can work with Tyler and his group with that as well.
Thanks.
If we turn to page 35, I know that we're going to talk a little bit about Roth or Roth conversion. We do have about 15% participation in Roth with a little over $2 million. So, and then there's 203 people participating in the Roth feature. So, you know, it's and that's about average of what I see is around, you know, between 10 and 20% of the plan participants. And it does have to do with age as well. So if you have an older demographic, you'll see it lower. And if you have a younger demographic, maybe in a tech company or something, tends to be a little higher. We'll just briefly chat about, on page 37, the asset allocation and how it's set up, just because you talked about it a little bit in Bill's presentation, here's how it breaks out. There's some demographic breakout on this. I won't spend a lot of time, but you can see that stable value has almost 23%, 23% in stable value, and Prudential's stable value is about 26%. So it is lower than what our book of business is, but you can see down below in the fund utilization by age, you've got, you know, people, you know, I would say about 30 people, maybe up to 50, depending on if you think 54 is too young to be in guaranteed account, that there's quite a few people that are invested in only one fund. And if you turn the page, you'll see that 70 of those people from the page before are sitting in solely in the guaranteed income fund. So, you know, kind of speaking to diversification and the things that Bill was talking about, this kind of lays out for you where, so the ones that you see that they're in the target dates, that's right. You want to see them just in one fund. But like when you see somebody in maybe just a bond fund, you know, that's not always the best thing from a diversification standpoint. So that's something else we can work with the committee and Saltus on, kind of looking at those people and seeing if there needs to be some extra discussion around that as well. Is there any questions on those pages?
No.
Nope.
Okay.
Pretty good diversification.
And then the last page I'll just talk to is page 41. And it just really talks about Goalmaker, because Goalmaker is your default status. So the average, if you look at the bottom of page 41, the average contribution rate is 7% into Goalmaker. Average length of time people stay in Goalmaker is just over 3.6 years. And the participation rate's just about 25%. If you look at the page below, then it talks about those that have defaulted into Goalmaker, where they haven't done anything. They went in the plan, they let auto enrollment work, and they're in there. That's about which is actually kind of funny, because most of the time these numbers can be swapped, where they actually have more people in the default category using Goalmaker, and you guys actually have people that are actively using it. So you've got 6.6 million that are just in there because they're in there. That's where you put them. But you've got 45.5 million where people have actually gone out and decided to use Goalmaker. So that tells me that there are people paying attention and they understand how it works, and it's good diversification for them. So that's great news in that respect, that people are using an asset allocation tool. And that's about it. I won't spend any time on the 457 because I know we're going to talk about maybe some plan design and other things on that. So I will turn it back over to Tyler unless you have other questions.
Okay, thank you, Kelly. Next on our agenda is just to spend a few minutes on, we've talked about it here and there a little bit, but participant support and education, and Tucker kind of heads that up on our team and helping us do that. And as you guys know, you know, we have multiple members of our team, but Tucker kind of takes the lead there in doing that. So just going to have Tucker take a minute and go through kind of the education efforts of 2019, and then and then just talk about kind of the on-site visits, and then a few of these campaigns that we've kind of already had a discussion around as we look into 2020.
All right. So a lot of the questions that have come up, I think, are very, this is where the one-on-ones are very important, because questions about distributions and hardships and stuff like that are things that I'm often helping participants to deal with. So right now, just as a reminder, Soltis is on site once a month, every third Thursday, and it's a two-part series. So what we do is I come on site, and starting at 9, do one-on-ones, and then from 10 until about 12, I help out Brandon with the new hire orientation, and do a group orientation there, and then one-on-ones from 12 on up. These meetings fill up really fast, and so there's definitely demand for people that want to sit down with advisors. Most of the questions that come up revolve around just getting ready for retirement and retirement planning. So the cash flow questions that we're seeing, people are curious, and even though it might seem like the answer is pretty easy to get, that's a lot of the questions I get, are just how to actually set up, you know, what happens in retirement. So it's no surprise to me that people are taking out loans, because a lot of the questions I get to are based around budgets and getting out of debt. And I think that's just a natural thing, especially for younger people that are starting off. I'll say that I've told people that it makes sense sometimes to not participate in the 401k, especially if there's medical hardships or a severe need for it. So there are times, and obviously it's a blanket statement, but I mean, there are some times where it doesn't make sense for everybody to participate. Other campaigns that we've been helping out with have been with the new the merging of the 401A and the 401k. And Prudential and Soltis was on site for 2 days to help out with that. We've had about 7 different group meetings. Had overall really great participation with those. And then recently with the benefits fair, Prudential and Soltis were also here on site answering questions. And from that, I've actually had a lot of conversations over the phone with plan participants. I'm asking for help with that. A need that I see for education is to get out to the prison. I know there's been a few police officers that have asked if there's a way for us to get out there. And then, like I said, the time that, so Brandon, and he can attest to this, when I send him the link for people to sign up, that will fill up in about 10 minutes. So there's a high demand there.
So it has been filling up, there's no blanks. Right?
There's no blanks.
So maybe we could have a session that's, you know, just for the employees in the jail, that would be only be available for them to sign up for. I'm just throwing that out because that's about half of our employees.
We're happy to do that. We know a lot of them have night shifts, and we're happy to accommodate to whatever we need to do there to kind of fit in that schedule there.
Yeah, Brandon can help with that too. To,
Yeah.
you know, get you a list of employees who would be on the law enforcement side.
Good, excellent.
Tucker's surprisingly comfortable at the prison.
Yeah.
He knows his way around.
We're all about diversity as well. We've got lots of different places that we do education.
Have you seen him there, Sheriff? At the prison? At jail? Okay.
I'm glad if you don't recognize him, maybe.
Try not to be recognized around there.
Yeah.
Yeah. Any questions about the one-on-ones or education that we've been doing? Any feedback or anything like that?
No, I think that's great, and I think it's been a good year. We've had a lot of really good feedback. You know, the benefits fair went really well. There was a lot of employees that came to that. Again, I'll just have, you know, Brandon get with you on plans for 2020 where we can do some reorientations to our 401k plan, our, you know, retirement plans in general.
Perfect.
We really want to focus on these employees who are zero in the plan.
Yeah, for sure.
And try to get some people enrolled to where they should be. So.
Okay.
So maybe just, and this might be ambitious, I think from our end, as we've looked at the plan and we've had some of these discussions in 2020, kind of drafting that, I think 3 things that we're looking at. One is the re-enrollment, where you've got employees that just need re-education on getting in the plan. 2 is you've got a significant population that's sitting in you got 70 employees that are sitting with their only investment in cash. Again, that might be appropriate, that might be intended for some. I'd be willing to bet that a large majority, that's probably not their intention, that we could work with on there. And I think the last one would be whether or not a retirement readiness specific for the county, where we can come and just do it here for your employees, where they can invite their spouses or significant others. Or those are kind of three efforts, I think, that it sounds like to us, and in terms of being here on site and demand that we see, that those are three areas where we could help move the needle. So,
Sounds great.
okay.
Okay.
And then the only thing I would add for you, Tucker, is that the Prudential Pathways that we held in September and October, I did just get the survey results back, and I sent them to Ralph and Mark. Maybe, Ralph, you could disseminate those to the rest of the committee. But we had some really great feedback as well on those seminars that they did. Everything was at 100%. I think the only anything below even 100% was, are people maximizing their retirement? It was like at 81.2, so they realized they weren't. We had about an average of 15 people at each of the 5 seminars. So, you know, with all the different options that people have, I thought it was pretty well attended, and some great feedback on what they learned and what they'd like to continue to learn is included in there as well. So, Tyler, Tucker, I don't know if you were able to come to some of those meetings, but we'll make sure that you guys see some of the takeaways from what they'd like to see as well.
Yes, that'd be great, Kelly. Okay, we can wind down with the last 2 agenda items on here. Kelly, if we want to kind of stay there, I know the next item we've got is kind of the 457 plan document discussion around the individually designed plan document versus the prototype. And so maybe I'll kind of start there with you, and we can open that discussion with respect to the current plan document that's obviously in place, and then maybe I'd turn to the committee members if there's specific things around the plan document that they're looking to have that would be more custom in nature.
So we did find out that we do have a 457 document that we would be able to offer to Utah County. Carol, I don't have the email up that says how much that costs, and for whatever reason, because now it's 5:30 at night, my Prudential website decided to download all the updates, so I got kicked off.
Okay,
So,
no worries. It's only 3:30 here in California, so I'm good. I'm still
So
on.
if you have, so yeah, there's some information about what we would charge, and do you have that?
You know,
Yes,
I actually have
so,
that. It was, $900 to set that up, as I recall.
Okay.
Well, it's actually for a suitability review. So what our compliance department would do is to take all the provisions that are currently on your individual document and then try to map them onto our government specimen document to make sure that everything is compatible and to make sure that you don't have any special provisions that would not easily translate onto our document. So that whole process of doing the comparison and to see that it is compatible is $1,800.
What if we just went with your plan document?
I think that before we would be able to put you on the document, this would be part of the process. Because, obviously it's an existing plan. It wouldn't be like you have no plan and you're all of a sudden adding a 457, where we would be able to start from scratch and ask you what do you want your plan to look like and what do you want the provisions to be. Because it already exists, we have to make sure that we are able to honor all of the current provisions that are currently in place on this plan.
My question, though, is what if we just want to go with the terms in your standard document and we're not worried about any inconsistencies? Is that an option?
Well, as with
We can ask, but I think they're going to want to make sure that there isn't anything in your individually designed document that would lead to somebody not getting a benefit or not having something that you're currently offering that we can't offer on our standard document. That's where the problem comes
So-
in, because you've got people getting something that we could potentially take away because of something that you put in your plan.
So as with any document, there's the base document, and then there's selections that you can choose as far as what you want your plan to allow or not to allow.
Sure.
So, that's what we're looking at is the specifics that your plan allows to make sure that it will map properly over onto our document. And of course, if it doesn't, then we would, offer it up to you to consider changing any of the provisions if that's something that you would want to consider. But we would have to do a comparison.
So how this, came to be is that when we were updating the 401, K, and eliminating the 401A is when I found out we had an individual plan for the 457 that we had actually, created ourselves. So the question was asked, why are we doing that? And can Prudential handle all of our plan, documents? And the answer was yes. And so I still support us going that route. I guess, is there any other, questions from the committee about how and why, even if it is $1,800, I think it's worth the change. That's just my opinion.
Well, I agree. I think that's a good idea to do that. I don't know why we need, or we'd want a custom plan with all the, not having all the benefits of having a Prudential approved custom format. I think that's a real advantage, and I think it would make sense to do that. My understanding is that would be a settlor expense,
Right.
Utah County expense, but I agree that it appears to be worth the money in terms of, I think, risk reduction alone.
Agreed.
It's also seventh opinion on it.
Yeah, we have a few plans that have written their own document. A couple of those, they have an ERISA attorney that chairs their committee. And so that's why they've done it. What I would say is if we have a choice or recommendation, we will typically always want to use a prototype document. The reason for that is Prudential, the process for this is Prudential will build these prototype docs. They go to the IRS. They get basically approval on, hey, this is how our document's gonna read. And so there's less room for error typically in the implementation of the plan when you're using a prototype document. Because usually a custom document will have some unique characteristics that a plan is wanting to have, which is, outside kind of the normal. So if there's an indifference, unless there's a need to say, hey, we have our custom document because there's these provisions and we have to have them in our plan, we would typically encourage you to.
But the
probably
review
use
would
the
identify those
Yes.
differences, right?
Yep.
Isn't that correct?
Yeah, and in ERISA world, as Kelly and Carol mentioned, in ERISA world, when you do that review, what you have to be careful is that you're not, if you change the plan document, that you're not taking away a benefit. Again, you guys don't operate in that world, but that's kind of the protocol that they're following to say, hey, are there any provisions or benefits that by moving plan documents we would be eliminating, therefore we want to be careful not to do that. So that's kind of what they do and go through, and then it's really just taking those through and saying, okay, they pretty much map up, now all we do is lay it into the prototype doc and go from there.
Who has to authorize the $1,800 expenditure though?
Oh, that'd be the commission.
Commission.
So I think we.
So we'd make a
need
recommendation.
Yeah.
Well, I would move that we recommend to the Board of County Commissioners that occur, that there be a review to determine if we can go with a prototype document.
I'll second that.
Okay, we have a motion and a second. All those in favor say aye.
Aye.
Aye. Motion will pass 5-0.
Just a quick follow-up on that. Kelly, do you have any information or knowledge as to why we had a custom document, or is this just something that was inherited?
Yeah, I don't have any idea. I don't know
Okay.
how long the plan's been in place. We've never really worked on your document because it's been custom.
All right, thanks.
Okay, the final item on there, and we'll try and wrap up, is to go through. So one of the action items from our last meeting was to look at the plan and kind of help you look at how you stack up with other government entities and their plans, how those plans may try and handle the Social Security gap that you guys have, and then looking at some of the design features. So Prudential does a really good job. This report if you got this one in front of you, is the one that we're gonna go into now. But Prudential actually does a really good report. We use this report for not only our Prudential clients, but for a lot of our other plans that are not at Prudential, because there's really good data here. But if you just turn to page 3, what this does is Prudential takes data from Plan Sponsor, which is a big provider. They go out and do a survey every year. They try and get basically 4,000 to 5,000 different plan sponsors to respond, and then they help compile this data. And then Prudential takes it and begins to help us look at it not only in just general terms, but even boil it down to specific industries. So you'll see in this insert in this survey, we'll go through it. There's about 4,000 sponsors that respond. Of those, 96 of the 4,000 are county, state, and federal government entities. And then you can see kind of how that's broken down. There's some additional as well. And so you'll see again, if you look down on page 4, what you're going to see is as we go through the report, it's going to, the report is specific. It's looking closely at the government, county, state, and federal kind of industry. That's the industry that you're in, so you can kind of see your peer groups and how they're looking at things. And then let me just take you down. If you go down to page, for example, starting at page 11, I'll try and orient you a little bit, and then we've got a number of pages we'll hit. We won't hit every page in here, but number 11, for example, in-plan Roth conversions. So this is something that came from the last meeting and getting your document amended to allow for these. But if you'll look on the left-hand side, you'll see the question kind of posed and the different answers. On the left-hand side, this is all industries. So this is looking at the retirement plan kind of landscape as a whole, whether it's government sector or private companies, everything all together. And then obviously on the right-hand side in green, the boxes that are shaded in green are specific to government, county, and state and federal type of plans. So for example, if we just take a look at in-plan Roth conversions, you'll see overall about 54% of plans, or excuse me, 35% of plans in the entire industry offer this. In the government and county, state sector overall, about 54% of plans offer it. And then those plans that are in your size, 50 million, about 200 million, it's about half that, so 50% total. So you can kind of see how they break it down by industry, then they break it down by kind of asset size and going through. And so I want to just take you through, I think, a few of these based on some of the questions that were posed for us to help you look at. So if we go to page 20 next, and I'm just going to touch on this one because this is as we just had the discussion around, hey, you've got a fair amount of people that are taking in-service withdrawals out of the plan, get to a certain age, and then they kind of roll out of the plan for some other reason. But for example, if you look at page 20, you can see hardship withdrawals. You can see which of the following in-service distribution options are allowed by your plan document. So again, looking at hardship, 81% overall in the government sector. It's 81% as well. In your space, hardship, 100% of plans offer hardship. And then you can see down below that there's different ones. Distributions connected to an attainment of a specific age. So you can see about 70% of plans overall. It's actually lower in the government sector, about 53%. And even lower than that at your plan size, only about 43% of plans offer an in-service. So, for example, kind of the common one is, hey, at 59.5, you can then take an in-service withdrawal, which means you can roll your assets out of the plan and do that. So that's an option that you guys have in place.
Yeah, we do have that.
And that's one of the reasons that you see $1 million or that 700,000. It's not all of that, but that's probably a good chunk of that. But you can see that's something that you guys offer that majority of plans your size don't. So again, not saying that you shouldn't offer it or you should, but to give you an idea of where other plans are. If we go to page 23, I'll just touch on this, and I think we understand kind of the commissioner's standpoint on auto enroll. So not to spend much time there, but 23 gives you an idea. You can kind of see overall how many plans. So in the government sector, about 34% of plans have auto enroll. Plans of your size, about 28%. And then going to page 26, we're looking at deferral rate, the default deferral rate. So as plans that do when employees enroll or they get enrolled in a plan, if they're being automatically defaulted into the plan, what's the deferral rate as to what plans put them in? And the reason I take a minute here is we've seen a pretty big transition in the last, I'd say, 5-10 years from plans and plan sponsors being more paternalistic in nature. So I can just tell you, 10 years ago, when you would talk auto-enroll with a plan, a lot of times the response was, absolutely not. I'm not about to just put somebody in something and have them get upset because we automatically put them into something. You've seen a very dramatic change now in acceptance. If you look at auto-enroll across the industry, you can see those numbers have gone up. In other words, you've seen plan sponsors say, hey, we're trying to help our employees. They can opt out at any time. And while initially maybe the reaction was, we're forcing somebody to do something, I would say you've seen a change in the industry of, hey, we're trying to help those participants. If they don't want that help, they can opt out at any time. So that's one of the reasons. But if you look at this, you'll see for plans of your size, the auto-enroll, about half of them, they auto-enroll people at 3%. So for those that do have auto-enroll, it's, hey, you're in the plan and you're gonna contribute 3% of your salary. The other half, they bump it up to 6% and do it there. So again, just kind of a couple of data points, I think, based on some of the discussions that we've had. On page 27, you'll see kind of the numbers around auto-escalation. Kind of the same thing here. Auto-enrollment came out first, auto-escalation shortly followed. You can see 66% of plans, so 2/3 of plans in your space and your size don't offer an auto-escalation. Those that do, you can see 16%, and then, you know, there's sometimes this data, like at the bottom, it says unsure, don't know. So 16% are saying, yes, we have it, and then another 16% are saying, I'm not sure. But at least gives you an idea, again, kind of where the market or where you're, you know, kind of what the competitive landscape looks like. Let me take you down to 30, because one of the questions was around participation and eligibility. So I'll say a couple of things. One is your plan stacks up and actually outperforms your peer group in a number of, I think, very important metrics, participation being one of them. If you look right now in the government sector overall, participation is about 66%, 67%. For plans your size, it's only about 55%. You guys are over 70 at 77, or is it 71 or 77%. So in terms of participation, your plan is doing quite a bit better than most plans of your size and in the government sector in terms of getting your people in and participating in the plan. Page 31, average balances, same thing there. You'll see that you got the overall, it's about 73. For plans of your size, it's about 67,000. You guys' average balance is about 103,000. So, you know, that may speak a little bit to your demographics, but at the same time, it also is showing that you've got good participation. You've got people that are accruing a good retirement benefit in here. On page 32, you've got active deferral rates. So for those that are contributing, at what level are they contributing? Again, overall, you guys are at 7.1% in terms of your contribution rate. Overall, it's about 6.7. For plans of your size, about 7.4. And even overall for the entire industry, you can see that the amount that your plan is contributing is better than what the industry average is as a whole.
One quick question there. All this data, is there an ability to break this out between those who participate in Social Security and those who don't?
I don't believe there is, but I'll defer that to Kelly. It's Prudential that kind of gathers the data and then puts it in. But Kelly or Carol, I don't believe you guys have that ability, but correct me if I'm wrong.
I don't think so either. Carol, are you aware of that?
Because I see that
No,
as a
I'm
big
not,
difference that would, you
Yeah,
know, when
a lot of
you're not.
plans just have automatic enrollment, and they don't really specify why. So there's really no way for us to determine.
The concern is we're comparing apples and oranges. And
Correct.
another follow-up question, though, is whether NAGDA has that information and whether they perhaps have it in the category of those who participate in Social Security and those who don't. You know, Kelly?
It would be worth a shot to reach out to
I would
NAGDA
agree.
and see. Because, again, Plan Sponsor is a association that looks at all plans, regardless if they're ERISA or non-ERISA, where NAGDA tends to be just governments, municipalities, and those types of associations. So they could have some other information, white papers or something that they did in a survey that we wouldn't know of.
So could you check on that? You're a member, aren't you, Prudential?
Carol, do you know if that's something we could get from NAGDA? I don't know if there's anybody.
I can try to find out.
Great.
They can only say no. But yeah,
Well,
that's,
and we can, you or I can talk to Julie Clausen. I know that she's been pretty active in NAGDA, so we'll see what we can do there.
That's who I
Thanks.
was going to reach out to.
Okay, good.
okay. A couple of the remaining slides I'll just take you to, and then if there's questions, but one was in terms of eligibility, when plans make people eligible to participate. So if you look at page 33, you can see that. You can see that the government sector is significantly higher or more generous in terms of letting people contribute into the plan immediately.
So this shows 100% for our class. Does that mean we did not participate in that survey?
Yes. So for those 96 respondents that were in this survey, all of them offer immediately upon hire.
So Ralph, that kind of goes to your point that we're real outliers.
Yeah, we
by not
are.
doing that.
And, this is really, really good information, but again, Dave is asking, really good point is, the social security factor is significant and, the behavior of our plans. So, and that's, I think, ultimately what we're looking about. But this is very helpful,
Okay.
yeah.
Well, we'll circle with NAGDA. I mean, part of that challenge is as you guys can probably guess, it's not a huge part of the overall market
Right.
that has that issue. So trying to gather
But-
enough
but
data
it's-
for those plans.
It's our section of the market. though,
Yeah.
you know,
Yeah.
so-
Yeah, no, which we get.
Right.
So I think as we look at these tools, trying to drill into that one that's specific might be a little challenging. I think Kelly's right. If there's anybody that might have, I would think NAGDA might have as good a
Yeah.
chance as any in terms of where we're at on
And
that.
the next page may give us a hint, because, if you're gonna be exempt out of Social Security, you're gonna probably offer a matching contribution,
Yep,
I would hope. And the next page talks about that, so.
yeah. So again, this kind of looks at, again, in that industry, it's looking at government, it's looking at counties, looking at states, and looking at federal. And so it's a pretty sizable group that not all shares the same challenges. But again, I think in terms of at least giving you an idea of where your plan stacks up, there's a number of good things. There's a number of elements here. The last thing I'll mention is part-time employment. That one's, I don't believe in here. But what I was going to say was, and there's more in here, so I won't take time because we're out of time, but there's a number of things, like if you were to go in and look at your ERISA account, for example, plans of your size in this survey, 100% of them said they had no ERISA account. You guys have had it for years. In other words, and that's not, when we started negotiating these years and years ago, most of the providers would say, hey, until you're 100 million, no, we just keep all the revenue share. And it took some pretty hard negotiating on our end on behalf of clients to have those. So there's a number of things that you guys have done. If you look at fee leveling, which we've already moved to, it's a very small percentage that's moved there, which we think is really the cleanest way to do it. So I think there's a number of things that you look at in your plan, that your plan is very much ahead of the curve and in good shape, and is a very good benefit for your employees. So you can go through, there's some additional ones that are there as you look at these type of items in here. And of course, if you have any questions, we're happy to take more time on it in helping you look at kind of those different metrics around your plan and how, and what they look like, so.
Okay, thanks for this information. It is very helpful. We're looking at maybe doing some upgrades in 2020, so this will be helpful.
Okay. And thank you. Prudential does a great job. Like I said, we use this tool of theirs for not just Prudential clients, but a lot of our own, because it has good data like that, so. Okay, I think that takes us through all of our agenda items.
Okay, does anyone have anything else that needs to be discussed with this group? Mark? Do I have a motion to adjourn?
What, next meeting is,
Oh, yeah, Mark, when's our next meeting? Oh, do we know when our next meetings are yet? Have we set our schedule for 2020?
yeah?
Glad to hear that, because that was gonna be a question. I was like, I hope I didn't miss an email, but I'm pretty sure I hadn't, but.
Do you guys think you're gonna keep them on the same schedule where you do the second Monday of the month after quarter end?
I think that's worked well. I don't see why we'd change it unless someone else has a good day.
Then I'll just mark my calendar for those dates
Yeah.
and times.
Okay, we'll go with the second Monday after quarter end,
February 10th,
February 10th.
according to Rouse.
According to my electronic brain.
Okay.
All right, anything else? Motion to adjourn.
To adjourn.
Second? I'll second it. All those in favor? Aye.
Aye.
Aye. Motion carries. That's it. Thanks.
You said aye twice, so that's